Looking for an under-the-radar, yet terrific business to invest in? Like the idea of getting a market-beating yield that comes with double-digit dividend growth? Want to learn about a high-quality dividend growth stock that looks undervalued right now? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a niche US retailer selling unique products. Retailing is a tough cookie. It's highly competitive and it's only going to continue to get more competitive. However, if you can run a great retail operation, you stand to make a lot of money. Well, this company is one such great retail operation. And it is indeed making a lot of money. It's also paying out a safe, growing dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Tractor Supply Co., which appear to be trading at a significant discount today. Tractor Supply Co., stock ticker TSCO, is an American retail chain of stores that sells products catering to farmers, ranchers, and customers living a rural lifestyle. Founded in 1938, Tractor Supply is now a $23 billion by market cap niche retail dominator that employs more than 36,000 people. Tractor Supply owns and operates approximately 2,300 stores spread out across 49 states. Stores contain roughly 17,000 to 23,000 products, along with 250,000 products online. I've said this before, I'll say it again. Outside of the mass market merchandisers, I believe that a retailer needs two important features in order to thrive in this environment. I'm not saying these two features are all a retailer needs. What I am saying is they're critical ingredients to success, and without them, a retailer will almost certainly fail over time. One of those features is differentiation. Differentiation allows a retailer to stand out from the pack and gain the attention of consumers. Tractor Supply stands out in a big way by providing unique merchandise to customers living a specific lifestyle. If you're living on a farm, you can't just go down to any old store and get what you need. Animal feed would be a great example of what I mean here. The other feature is a coherent, cohesive, omni-channel strategy. Almost every successful retailer I've studied has this. While Tractor Supply is growing its e-commerce platform, this is one of the few retailers where this feature isn't quite as crucial as it usually is. Morningstar puts it like this, and I quote, "A unique merchandise assortment partially insulates the firm from e-commerce competitors offering products that have either immediate need or are expensive to ship," unquote. Let's go back to the animal feed example. Animal feed is not something that a farmer is likely to buy online. It's often needed now, and it's very heavy and expensive to ship. Morningstar adds more to this story. Again, and I quote, "Tractor Supply continues to see e-commerce growth up a mid-single-digit clip in 2022. We suspect e-commerce makes up a high single-digit percentage of Tractor Supply sales, well ahead of the farm and ranch retail average of about 1%, unquote. Despite having a retail model that isn't necessarily a good fit for e-commerce, Tractor Supply is excelling in this area and clearly well ahead of the competition anyway. Being ahead of the competition is nothing new for Tractor Supply, and that's why it has a long runway for revenue, profit, and dividend growth over the coming years. To date, the company has increased its dividend for 14 consecutive years, and what a fast start Tractor Supply has gotten off to. The monstrous 10-year dividend growth rate of 26.2% shows that. Now, one often has to sacrifice yield in a big way when the dividend growth rate is this high. However, that's not the case here. The stock offers a very respectable yield of 2%, which easily beats what the broader market offers. That yield, by the way, is 70 basis points higher than its own 5-year average. With a low payout ratio of 42.4%, even after all of that dividend growth, there's still plenty of headroom here for the dividend to go higher. This is a safe dividend that's growing at an astounding rate. Excellent dividend metrics here. Looking at business growth, Tractor Supply advanced its revenue from $5.2 billion in fiscal year 2013 to $14.2 billion in fiscal year 2022. That's a compound annual growth rate of 11.8%. Very strong top-line growth here. Earnings per share grew from $2.32 to $9.71 over this 10-year period, which is a compound annual growth rate of 17.2%. This is highly impressive. That said, seeing as how the dividend has grown faster than EPS over the last decade, which expanded the payout ratio, I would expect the two growth rates to be in closer alignment over the next decade. The main cause of excess bottom line growth, from what I can see, has been margin expansion. Opportunities for future margin expansion may be less accessible though, so that could constrain earnings per share growth just a bit. Looking forward, CFRA believes that Tractor Supply will compound its earnings per share at an annual rate of 15% over the next 3 years. I like that number. As I just noted, it's quite possible that a lot of margin expansion potential has already been taken advantage of. CFRA delves into this, and I quote, "We anticipate stable operating margin in the near term as Tractor Supply opens 2 new distribution centers and demand normalizes for higher margin items, while transportation costs decline and demand increases for lower margin items," unquote. Furthermore, the pandemic resulted in a population shift away from urban areas and into suburban and rural settings. While that's great for Tractor Supply, this isn't a recurring phenomenon. On the other hand, I think Tractor Supply is still in the early chapters of a long growth story. The small store count relative to other major retailers gives the company an easy pathway to higher revenue and bigger profits, which should translate to a larger dividend. Indeed, CFRA notes that Tractor Supply, and I quote, "continues to execute its long-term strategic plan to aggressively expand its store footprint, remodel stores, and add side lots to hundreds of stores," unquote. I think CFRA sums up the investment thesis well when it gushes over Tractor Supply's, and I quote, "specialized market niche catering to untapped rural areas and consumers with above average incomes and a below average cost of living, which we believe differentiates Tractor Supply from other general merchandise retailers, pet retailers, value retailers, and home center retailers," unquote. I have zero issues with CFRA's growth projection. If we take that as our base case, it would allow for like dividend growth over the next few years, and that could settle into a high single digit to low double digit rate of growth over the medium term, starting out with a 2% yield. This easily sets shareholders up for an annualized total return in the double digits. I see nothing to dislike about that. Moving over to the balance sheet, Tractor Supply has a stellar financial position. The long-term debt-to-equity ratio is 0.6, while the interest coverage ratio is nearly 40. Profitability is extremely robust for a retailer. Over the last 5 years, the firm has average annual net margin of 7.2% and annual return on equity of 44.8%. Circling back around to margin expansion, which I touched on earlier, Tractor Supply was regularly printing net margin closer to the 6% level at the beginning of the last decade. I also want to point out how exceptional the ROE is, considering that Tractor Supply doesn't utilize a lot of leverage. From everything I can see, this is a special retailer. And with economies of scale, brand power, an entrenched foothold in a niche market, and a unique product assortment, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Retail is infamous for its intense competition, although Tractor Supply's differentiation model alleviates some of the competitive pressure. Retailers do not benefit from switching costs, but Tractor Supply's unique product mix in locations with limited or no alternatives is a boon to the business. There is exposure to the idiosyncratic economics of farms and ranches. A recession could temporarily affect the business, but the non-discretionary nature of some of its products, like feed, helps to protect Tractor Supply. I see the balance sheet as an edge, but the company's plans to aggressively grow the footprint and improve existing stores could start to weigh on this superior financial position. Tractor Supply's e-commerce channel is still nascent and behind many other retailers. There are no real barriers to entry, which could invite future competition. I believe we're mostly looking at a pretty standard array of retail risks, but Tractor Supply strikes me as an extraordinary operation. And with the stock down nearly 15% from its 52-week high, the attractive valuation makes the operation look that much more investable. The stock is trading hands for a price-earnings ratio of 22.2. That compares favorably to its own 5-year average of 23.4. Not a huge discount, nonetheless, it is a discount, since one could argue that Tractor Supply is currently in a better position than it's ever been in. A discount instead of a premium is surprising. Also, the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis that factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is on the high end of what I allow for. Now, it's rare that a retailer gets the designation from me, as retailing is so tough and competitive. However, Tractor Supply is also a lot smaller, both in market cap and store count, than a lot of other retailers I track. Because of that, among other reasons, I think the company is still in the early innings of a long game of outsized growth. There's so much room for footprint build out here, and the returns on capital are very high. Overall, it's a terrific business, and terrific businesses tend to get the benefit of the doubt from me. The dividend discount model analysis gives me a fair value of $222.48. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates TSCO as a 3-star stock with a fair value estimate of $214. CFRE rates TSCO as a 4-star buy with a 12-month target price of $270. Averaging the three numbers out gives us a final valuation of $235.49, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. Tractor Supply Co. is one of America's best retailers, and yet its small size would indicate its best days are still yet ahead. With a market-beating yield, a low payout ratio, a double-digit dividend growth rate, nearly 15 consecutive years of dividend increases, and the potential that shares are 9% undervalued, long-term dividend growth investors looking for a high-growth business should have their sights trained on this name. And now for a special news announcement. Microsoft Corp, stock ticker MSFT, is off to the races. This stock is now up 37% year to date on the back of AI promise. I keep hearing the same things from the naysayers over and over and over again. Overvaluation, low yield, too big, etc. Yet all Microsoft does is make their shareholders richer. We highlighted Microsoft only a few months ago, giving it the honored distinction of being a dividend growth stock that's so high quality, one should consider owning it forever. If you don't yet own a slice of this wonderful business, you really should be questioning that choice. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.